Hello, this is Rich Siegel with ARQ Wealth Advisors. It is 1:35 on Monday, and with the market turmoil, we figured it'd be a great opportunity to touch base with our clients and our friends. It was ugly today. The Dow Jones closed down 2,000 points and change. That is the worst ever point drop in the Dow in history. Not the worst percentage drop, not even close, but definitely the worst point drop. So it's been ugly over the last 2 weeks with this coronavirus outbreak. A couple things I want to show you here. This chart is a chart of the VIX, and the VIX is the implied volatility indicator, or the fear index. And there has been fear, and that's why the VIX has spiked to as high as 60 today, 60 plus today. That's quite high. To put that in perspective, at the height of the credit crisis, the Great Recession in 08-09, it surged to about 80. Now, these are temporary. So what happens is they spike at peak fear and panic, and then it comes back down again. And during these kind of troughs, it tends to be around 18, 19, 20 historically on average. But during these troughs here, what tends to happen is the market goes up. Low volatility, strong stock market. So what will bring this down? A few things. One is that stocks just get so cheap that buyers come in. Right now is a good time for a long-term investor. Right now is a great time to own stocks at these levels. Eventually this will end and subside. Next week also, the Fed is meeting, the March meeting. Jerome Powell and team will most likely cut rates again. Lower rates will help to stimulate the economy. It helps the consumer with buying cars, refinancing their homes, small business lending, etc. And it's much easier for businesses to service their debt if rates are low, and the government as well. Okay, so that's what will bring it down. I would say that we're probably due for some type of reflex snapback rally here. Things don't go down every single day forever. This is probably oversold based on the worst case scenario, which would be the spreading of the virus along with a recession. Now, that may happen. A recession might happen. I know companies are cutting back on travel and meetings and so forth, and consumers in certain parts of the world are not out and about. So from a market standpoint, prior to today, what you'll notice here, this is a 1 month chart, not including today. Over the last month, Treasury bonds, short-term Treasury bonds are up about 2%. The basket of non-traditional low-risk alternatives that we use are down about 1.5%. Emerging markets, that's primarily China, India, Brazil, down about 8%. And the Dow is down about 11.6% prior to today. So what we have today is about a 7.5% drawdown, which means the Dow is going to be down close to about 18, 19%. So pretty ugly. From a valuation standpoint, we don't quite know the earnings yet because this is new and earnings will be hit. But you're probably going to look at forward earnings in the 15 to 17 times price to earnings ratio. That's about the average historically and well below the average historically when rates are this low. So stocks are getting quite attractive. They were a little bit extended. And if you remember, at the end of last year, we did remove some risk from the portfolios. And we did it again, good timing, about 3 weeks ago. We sold about 5 to 10% of equity exposure in client portfolios in favor of this over here, the bonds and the alternatives. So hang in there. I know this is upsetting. But no need to panic. Unless you're selling it all today, you haven't taken any losses yet. These are paper losses. This will come back. Typically takes a month or 2 or 3. Here's our disclaimer language right here. And if you want more color around this, if you want to chat, we're always available. Please reach out to your advisor. So stay healthy, try to stay relaxed, and we'll speak to you soon. Thank you.